Hi, IBD. I'm Meredith Heyman. This is Industry Insights. Thanks so much for joining me. We're counting down to 2024 with new investment themes and strategies. What role will big tech incorporating AI play in the markets? And how will potential 2024 interest rate cuts influence investors? Joining me to ring in next year's market themes and trends is Blackrock U.S.'s head of thematics and active equity ETFs, Jay Jacobs. Jay, thanks so much for chatting.
Pleasure to be here, Meredith.
All right. So before we look ahead to 2024, let's look back. What were some of the themes we saw in the market for 2023?
I think one of the main themes from 2023 was caution. You saw over $6 trillion come into the money market and cash space in the United States, meaning that investors really were just happy to collect basic yield on their cash instead of putting it to work in the markets. We did see some investors start to inch into the markets using things like buffered strategies to get some upside participation while using options to protect against the downside. But by and large, this was a story about people holding dry powder on the sidelines, waiting for a better market environment.
All right. Now, how will the evolving state of the U.S. economy affect the market come next year?
Well, I think one of the biggest things that's happening in the US economy is domestic manufacturing. So you've seen really over the last several years a lot of policy in the United States to reestablish ourselves as a manufacturing center. You've seen the Infrastructure Investments and Jobs Act, a $1 trillion commitment to rebuild infrastructure in the United States. You had the Inflation Reduction Act targeting things like electric vehicles and clean energy to build those high growth industries in the United States. And you saw the Chips and Science Act bringing tens of billions of dollars into semiconductor manufacturing. So there's been a lot of emphasis on gearing up the US economy to be centered around manufacturing. The challenge is we actually don't have that much manufacturing capacity in the US. Our workforce is likely not to grow at the same pace as it did over the last 10 years in the next 10 years. And what that means is you need to really reestablish new supply chains around the world. For example, Mexico this year became the US's biggest trade partner, and that is no surprise. That is because of the Inflation Reduction Act and Mexico's use in the supply chain of things like electric vehicles. India has been an incredible and growing partner with the United States as well. So for the 2024 economy, there's a story about what are we producing in the United States, but it's also a story about who are the partners in this really kind of changing global landscape going forward.
Yeah. Now, speaking of partners, big tech and AI, they're going hand in hand, and that's only going to continue in 2024. What should investors know?
Well, 2023 was really a year of proof of concept for AI. We saw, ChatGPT and so many different platforms coming out with new AI, generative AI models. Going forward, though, it's going to be about commercialization. How do they take these technologies and products and turn them into revenue generators? That will impact things like the semiconductor space, where graphics processing units and central processing units will be in very high demand as we have more and more AI growth. That'll impact things like digital infrastructure, where AI doesn't just happen in the cloud in the middle of nowhere. It happens in physical real estate, in physical locations that are increasingly high demand. And then finally, I think we'll see a lot of economics flowing through to the applications that are integrating AI into their products. Think about travel companies where right now you have to book your flights, you have to book your hotels, you got to book your restaurants. All of that onus of trip planning is on the consumer, on the traveler. There's really no reason why generative AI platforms can't optimize a trip around your preferences and your dates that you're looking to travel. So we're seeing that already being incorporated into things like consumer travel sites. But you look at the legal field, you look at programming, you look at the medical field. There's so many different sectors of the economy that could benefit from similar levels of integration with AI going forward.
Now, what about investing in healthcare come 2024? Is that going to be a popular sector for investors?
I think it will. And really, we have to take a step back and look at the broader trend in healthcare, which is in 2024, we will, for the first time, have more people over the age of 65 in the United States than we will have people under the age of 15. This is a huge shift in the landscape from 100 years ago, where you had about 5 to 6 times more people under the age of 15. This is clearly a story about aging populations. People are living longer. People are having fewer kids. And it really changes the demands on the economy, and where that's going to be felt most acutely is going to be in the healthcare space. So we can look towards certain drug categories where we really would expect to see growing demand. Part of that is going to be in Alzheimer's and Parkinson's and other neuroscience related drugs, as these predominantly impact senior citizens. 1 in 9 people over the age of 65 already suffer from Alzheimer's. If you go over the age of 85, it's about 1 in 3. So this is really a advanced age-related disease. But then secondly, one of the big stories of 2023 was the GLP-1 drugs. These are drugs that really are designed to treat diabetes, to treat heart disease, to treat obesity. We've seen a lot of pickup of those drugs already, but 2024, I think we're going to see a big acceleration again for aging populations where heart disease and diabetes predominantly impacts these people. GLP-1 drugs are going to be a really powerful solution.
And potential interest rate cuts for next year. How will that influence investors?
This is the flip side of what we saw as the theme of 2023 of people holding cash, which is if we start to see interest rate cuts, cash starts to look less attractive. If you're getting, 5+% yield right now, that could start falling to 4%, 3.5%, starting in the second half of next year. So I think this is going to put a lot of emphasis on people bringing money out of cash into the markets going forward. And that could really provide some great tailwinds for the equity markets.
All right, Jay. Now, do you have either a personal or an investor New Year resolution for 2024?
My resolution is not to be carried away by the swan song of high cash yields. I think it is most important for myself, for investors around the world, to really think about what are the precise opportunities in the markets today that can really drive returns going forward. If we look at 2023, the S&P is likely going to end up over 20% this year. So even though 5% cash yields looked nice, really the best result for investors would have been to stay invested, especially those that can take equity risk. So just because yields are high doesn't mean that's a great way to build wealth. And I think investors really need to look at those precise opportunities where they're going to see growth in 2024 and beyond.
All right, Jay. Well, very, very soon we're going to see how this all plays out. Thank you so much for joining me.
Thanks for having me.
This is Industry Insights. I'm Meredith Heyman. We'll see you next time.